Hello, my name is Mike Florin and I'm the owner of Low Cost Mortgage. Today is your weekly update for the mortgage industry for realtors and industry professionals for the week of October 20th, 2023. Last week, short week. Whenever there's a short week, we're not going to do a video, just FYI. So this week, we're going to recover a little bit from last week and then also this week. So I'm going to show you some charts real quick. Pretty interesting though. First and foremost is outlook into the future. Right? Last October, around October 20th, 26th, that was the highest rates went. And if you look at this chart, they went up till October and then they came down and settled for a good chunk of the year. November, December, they came up a little bit, January, February back down. So, but for last year or for the previous year, October, middle to end October was that marking point where rates came down. Well, here's the interesting part. It also happened 2 years ago in October. So what does that mean for rates in November, December? If it follows the trend of the last 2 years, and last year was a raising rate environment, maybe it'll settle down and stabilize a little bit, for the next 2 months. But there is something different though for upward pressure on rates, and that is inflation. Well, they've been trying to fight inflation for the last year and a half or so, really heavily for the last year, and it's going to be interesting to see what rates do in relation to fighting inflation and all of the adjustments that everyone's doing for that. But then also historical trends of November, December having lower T-bill rates, lower mortgage rates, supply and demand of cash, that kind of thing. So we'll see. Now there is something I wanted to bring up to everybody, and that is a lot of mortgage companies are going out of business or they're hurting and they're not doing very much volume. And we got an award for sending in a lot of volume. We sent in the most volume to this particular investor in the third quarter of 2023. So our company, Low Cost Mortgage, small little company that we are, outperformed everyone else in the country with this investor, and this investor's been around for a while. So it says a lot about what we're doing. So that's a good positive, right? If everybody else is really hurting and we're having the busiest months we've ever had, we must be doing something right. Interest rate wise, last week, rates were pretty good on Friday. Conventional was low sevens par. Government tapped sixes again, par. This week, everything went up about 0.5% or so. Let's see here. We've got conventional in high, middle-ish sevens, not low sevens like last week, but this week, par is kind of middle sevens. For government, you are low sevens for par this week. And I don't want to give you exact numbers because I got to put a bunch of disclaimers up on the screen. The big thing is typically if you do conventional 25% down, you get a pretty good rate or a lot lower rate. That's not the case this week. A lot of that has to do with just what we call, I don't want to use a technical terminology for it because we just don't want to do that. When you have rates that go up and everybody's starting to compete on a roof and everyone starts bouncing off of a roof or the top of interest rates, you start to see that some of those programs that you would have better pricing in, the margins tend to compress against each other. There I used a technical term. They tend to get smaller, right? But that's just what we're seeing. 25% down conventional usually gave you 1/4 or 0.5% better in rate. Well, if you look at that little rate chart that I send in the email, it's, I think, 1/8. So it's not really that big of a deal. It's not even 1/8. It's just a little bit better for lender credit is really what it is. Anyways, how to sell homes in a higher rate environment. I was pricing out a deal in Texas today, and they were really wrapped up into rate because they were quoted by a bank 2.5 months ago, and they thought if they got pre-approved at a bank 2.5 months ago that that's their rate for 6 months, and that's just not the case. So we were going over rates, and when we broke down the payment difference between what the rate was 2.5 months ago to what it is now for their $400K loan amount, the payment difference was $170 per month. It wasn't very much. So here's a thought for realtors, and remember, I used to be one. In fact, I sold quite a bit of real estate. Not the top producer, but I've got awards, and the awards sit over here for selling real estate. So I understand with realtors, I understand what you're going through, right? Rates are high, what do we do? Well, there's a lot of realtors that are selling a lot of real estate. They're not letting rate defeat them. Well, here's a few tricks to help help, I want to say, bypass anxiety over interest rate. First and foremost, rates before the pandemic, and this is a year or so before the pandemic, we were in, low fours for Govy, mid-high fours for conventional. Investment property was low fives. If you wanted to look at that as where rates could be in anywhere between a year and a half, 2 years to 5 years, you can. That's roughly where they were for decent credit. That's one way of going around it, and which is what I'm telling most people now. Every single loan that we generate that's purchasing a house now, it's not if, it's when will we refinance them. And that could be anywhere between a year and a half to 5, 6 years from now. That depends on this next election cycle. But that's going to go into a different conversation we don't want to have. But that's one thing, right? The other one is the payment difference. Well, if the payment difference is only on a $400K loan what it was 3 months ago to now is only $170 per month, when the payment itself is $2,600 per month, is that effectively a large difference? Not really. I know that it helps a lot of borrowers when I'm talking to them, and I'll compare where we are compared to other lenders and put it into perspective. They tend to just fall right in line because they understand, okay, this is actually perspective. This is maybe I'm concentrating too much on the wrong thing. Let's look at the big picture. Do I really love this house? Do I love the shag carpet in the bay window? I do. Okay, is this payment okay? And then later on, payment could be around here. Are we good with that? And that's where a lot of realtors that are selling a lot of homes now are going. And that's what we're seeing, because we have realtors that are still selling 2, 3, 4, 5, 6 homes a month. And we're doing a lot of those loans for them. But they're not focused on rate at all. In fact, they're mitigating rate or bypassing rate as an entire conversation based on, do you really like it? Well, here's the payment for what you like. And I know that's kind of a car thing, right? That's what car people do when they're selling a car. It's, hey, this car is only this much per month and don't worry about the rate. Well, not don't worry about the rate, but let's focus on what our immediate needs are. You really like the house, you really like the shag carpet in the bay window. Okay, the payment's going to be a little higher now than what it was. Yeah, is that not as good as it could be? Sure, but is it much better than renting, or is it worth what you want to buy, right? That's when it comes into realtors actually getting out there and selling real estate, right? Anyways, I could ramble on for hours. If you have a question, give me a call. Mike Florin, Low Cost Mortgage. Have a good weekend. I'll talk to you later.